Hello everybody, my name is Professor Sujata Iyer and I am a banker. This module is about the basics of microfinance. Microfinance is revolutionary in the field of finance today. Let's proceed by learning the basics of this subject. What is microfinance? Microfinance is essentially the supply of loans and other basic financial services to the poor. Every single individual has not only the potential but also the right to have a decent life. This is now a possibility through microfinance. That involves poor people having access to loans without any form of security. The amount involved these days are small amounts of money, sometimes as low as $500. However, depending upon the country where it is lent, the definition of what constitutes the minimum amount to microfinance differs. Certain governments internationally have recognized any amount between $5,000, say up to $25,000 as amounts being part of microfinance. There are different forms of services provided by formal banks. Formal banks typically do not take a lot of risk. While there is an element of risk involved in banking, but formal banks refrain from taking huge risks, or at least used to refrain from taking huge risks in the past. However, with the advent of microfinance, the loans that they provide are different from what the services that are provided by formal banks. Let's study that in a little bit more detail. Now, how is microfinance different from the services provided by formal banks? Formal banks require, at least for lending, formal banks require some kind of security if they have to advance loan to people. In case of microfinance, the lending happens purely without any security. The only security that is taken is to link the honor of the people involved in one group. Now, how different is the services provided by microfinance from that of formal banks? Now, the loan mechanism is based on a simplified loan process. Now, these usually last for a period of 1 year, and installments are paid weekly, or rather the repayment is done weekly by the people who avail of this loan facility. The interest rates are slightly higher than what is offered by banks, normal banks. Here the interest rates are as anywhere between 20 to 70% depending upon the country where the lending actually happens. Each loan, since microfinance is given without any security, each loan is associated with a group of 5 to 6 borrowers that provides accountability to keep the borrowers keep accountability of people who have borrowed from their group and ensure that the repayment happens periodically. In other words, because there is a group of people involved, this acts as the only security. The honor of the people within the group is the only security that is provided while lending in the form of microfinance. One of the mechanisms used is the concept of group lending, where groups of poor borrowers act as guarantors for each other. If one failed to pay back a loan or missed an installment, then all others would be held equally accountable. Now let's move on to the next slide, which is the effects of microfinance. What is the outcome of microfinance? What are the benefits that accrue on account of microfinance? How does it help? It helps poor households meet basic needs and protects against risk. The poorest of poor do not have access to loans because commercial banks do not lend without any security, and poor people, for example, even if they have land, more often than not they do not have title to it, so they aren't even able to, they don't have any security. Even the small land that they have, they may not have access, they may not have title to it, so they have no security against which they can borrow. This microfinance helps the poor households meet basic needs and protects against any risk that they may face in the future. The poor are also able to cope with any economic shock that might come from time to time. Say for instance a famine, or if there are floods. Microfinance gives them a good option to recover from such economic shocks. Microfinance also build financially self-sufficient institutions. In India itself we have such microfinance institutions today like SKS, Spandana, Spurti. ICICI Bank at one time had a microfinance arm, and so on and so forth. Most of the lending that happens through microfinance is given to women. The general idea behind lending to women is, when you lend to a woman, she does not spend just on herself but ensures that she spends it on her family as well. Thereby, along with her, she takes care of the growth of her family. She is also able to supplement the family's income through setting up a small business, be it tailoring business, maybe basket making, weaving. So these are examples how women can get empowered and contribute not only to their own growth and well-being but also to the growth of their family. Like I said in the earlier slide, when money is lent to women, they don't focus just on themselves. They make sure that their kids are also well educated, and thus microfinance provides better education and educational facilities to people who are very, very poor or on the poverty line. Now let's move on to the next slide, which also talks about the effects of microfinance. Because microfinance lends to women, and women are seen as borrowers, the income in the family rises on account of women setting up their own businesses. and therefore there is a possibility that even at the lower levels there are double income families, leading to higher incomes. Because they take on entrepreneurial activity, there is creation of jobs. Because one person supports the other people, because the lending happens through self-help groups or through groups of people, there is cohesiveness. There is cohesiveness in the community and healthy competition. Creation of jobs leads to entrepreneurship. Now there are certain myths associated with microfinance. Let's study some of those. The first one being that the poor are too costly to reach and motivate. Like I mentioned earlier, everybody has not only the right, including the poor. When I say everybody, it means the poor as well. They not only have the right but also the potential to alleviate themselves from poverty. The urban are anyway made, the people in the urban area anyway avail of loans to improve their lifestyle. The poor people deserve no less. It's only if someone is willing to invest in them through loans and advances, can they also come out of their poverty. So it's a myth that the poor are too costly to reach and motivate. They will only be too happy to avail of a loan if it is provided to them. And I emphasize, if it is provided to them. And the very high repayment capacity, the repayment, it's proven time and again that any kind of lending through microfinance, the repayment is high as 97%. Now, institutions for the poor cannot be financially self-sufficient. This is also a myth. Grameen Bank, SKS in India, Grameen Bank in Bangladesh, SKS in India, Spandana Purti. Okay, these are all institutions that are totally self-sufficient. So it's a myth that institutions for the poor cannot be financially self-sufficient. Another example is one of the oldest one of the oldest institutions called Seva, which was started by Ela Bhatt in Gujarat, Ahmedabad to be specific. It's another example of an institution that is financially self-sufficient. So it's a complete myth that institutions for the poor cannot be financially self-sufficient. And that the next point, that such institutions will only add a debt burden to the poor, is also a myth and continues to remain one, simply because when we lend to the poor, they return it with as much honesty as the rich do. Now let's see what are the risks associated in microfinance. There are three types of risks associated. Entrepreneurial risk, field partner risk, and country risk. When I talk about entrepreneurial risk, okay, there is a possibility that when somebody secures a loan for business, when a poor person secures a loan for business, there is a possibility that his business might not do well. There is also a possibility that there could be health issues and that he may not be able to take his business forward. So this is the basic entrepreneurial risk. The second risk is field partner risk. Now, since microfinance is spread geographically across country, it's not focused in one particular area, there is a possibility that people who partner with microfinance institutions could prove risky to the system on account of frauds. They may siphon off funds, or they may not lend the entire amount to the deserving poor, or there could be inefficiency in operating or making the loan available to them. The third is the country risk in which the lending happens, where micro credit or lending happens. Countries which are economically not sound, like some of the African countries, politically unstable, like some of the Middle Eastern countries, and countries which are prone to natural disasters. In such areas, microfinance could be a big risk. Now, how do we assess the annual interest rates, and how do microfinance institutions set sustainable rates? After all, the rates that they charge from customers are very high, and after having seen the kind of risks associated, you must be wondering, how do they set sustainable rates? To understand that, you must understand certain criteria that go into setting interest rates, like annual expenses, which is denoted by AE. Now, all annual expenses include recurrent costs like salaries of the people and the field personnel who partner with the microfinance institutions, the benefits that need to be provided to them, the rent and utilities that have to be provided, and depreciation of assets involved in the microfinance process. These range anywhere between 10 to 25%. Now, while I told you that 97% of repayment happens, there are some loan losses as well. There are default cases as well. So there are annual losses on account of default loans. Now, what is the cost of funds, or how are funds made available? The funds made available to the poor, at what cost are they obtained, is something we will study now. The actual cost of funds of microfinance institutions, when it funds its portfolio with savings and commercial debt. Now, this can be determined by using the estimation method, that is financial assets times higher of the rate that local banks charge of medium quality to commercial borrowers, or the inflation rate projected for the planning period. How do we now arrive at the actual interest rates? It includes the annual expenses plus the cost of funds plus the investment income plus the desired capitalization rate divided by 1 minus the loan losses. Now, K in the formula represents net real profit the microfinance institution would like to achieve as a percentage of the loan portfolio. Usually it is 5 to 15% of the average loan portfolio. II is the investment income, or the income that is expected to be generated by financial assets excluding the loan portfolio. Now, all these sum to high rates, but micro entrepreneurs are those people that obtain microfinance and get into entrepreneurship. These people will generally provide high returns than their wealthier counterparts who already have access to capital. That is, the return the return through lending on account of microfinance is much more than what one can expect when it is lent to people who can afford to take loan otherwise. Say for instance, in the urban areas where we lend at the rate of maybe 11 to anywhere between 11 to 15% through microfinance, when the lending is done, it is anywhere between 20 to 70% depending upon the country that it is lent. So you can imagine the earnings when you compare it in this fashion. Now, how are fees and service charges collected through the entire process of microfinance? Now, the fee is generally calculated on the initial loan amount. Whatever is the initial loan amount, the fee is calculated as a percentage of that, which differs from country to country, and it is collected upfront. Because the payment is upfront and is not calculated with the declining balance method, it has greater effect than nominal interest rate hike if the method is on the declining balance method. Now let's understand what cross subsidization of loans mean. Now, cross subsidization of loan is nothing but how an institution is able to manage microfinance and normal lending. Say for instance, when the normal loan and advances are given to people who can afford, the interest rate charged there is much lower than what is charged when using microfinance as a mode of lending. So how the difference is actually taken care of is known as cross subsidization of loans. There's an example here of Grameen Bank of Bangladesh. 8% rates on housing loans are subsidized by 20% rate for general loans, which means Grameen Bank can afford to charge 8% on housing loan because it is able to charge 20% for general loans. Also, in order to avail of housing loan through Grameen Bank, the borrower must have at least 2 general loans and must have had an excellent repayment history. That is his only credit worthiness. How can one assess the credit worthiness of a borrower who is very, very poor? The only way to assess the credit worthiness of a borrower, of a very poor borrower, is through his repayment capacity. If his repayment capacity is flawless, it means that he is of a very high credit worthiness. Unit Desa system in Bank Rakyat of Indonesia also follows cross subsidization, this is another example of cross subsidization of loans. In this case, there is higher return on the average assets than the bank as a whole. As for Grameen Bank mentioned earlier, high rates on poor loans subsidize low rates for wealthy. There are high rates given. The high rates that are given to poor people is set off by not set off, but high rates on poor loans actually bring down the rates at which lending happens to wealthy people. Let me put this in a different way. We are able to lend to wealthy people on lower rates of interest because we charge high rate of interest from the poor people. Also, there is low transaction costs for wealthier clients who pay lower rates on bigger loans because the ticket size the average ticket size of loans given to a person who can afford it is much bigger than the ticket size given to a borrower who's very, very poor. Now let's cover some of the challenges encountered in microfinance. These are some of the challenges. The first challenge being internal control systems. Now, internal control comprises the institution mechanisms to monitor risks before and after the operations. In microfinance, it is threefold. First, to verify the effectiveness and the efficiency of the operations. Second, to assure reliability and completeness of financial management information. And third, to comply with the applicable laws. And regulations. Supervision. Supervising and ensuring transparency in microfinance is extremely difficult because of essentially staffing constraints, geographic dispersion, and the MIS. In fact, staffing constraints, geographic dispersion, and MIS is a subset of supervision. Now let's understand a little bit about staffing constraints. Not everybody might want to get involved in the area of microfinance. People might not find it as a good career option because of the stresses involved on account of traveling, not very high salaries. So you may not be able to find the right staff in case of microfinance. The MIS is difficult to obtain because microfinance is spread across geography. So to obtain the correct MIS can also be a problem. Geographic dispersion is a challenge because geographic dispersion is another challenge faced in microfinance, as is donor pressure. Now let's study how microfinance is a benefit to investors, that is, people who are willing to invest in the field of microfinance. These are some of the benefits to investors. First, contrary to popular belief that the poor do not repay on time, there is evidence that 97% of the loans lent come back. The default is as low as 3%. So the default rates are indeed very, very low. There is a lot of detailing and a lot of nitty-gritty is assessed before the lending actually happens. That comes under high granularity. The loans are highly standardized. It's not different for different people. It is highly standardized, so that provides a safety net again for investors. Now, because it is highly diversified, because it is given to people in different vocations, different geographical locations, etc., there is high diversification, so that lowers the risk. And the poor are really not capable of prepaying a loan. Whenever a loan is prepaid, the profit comes down. So because there is low prepayment, the risk of lowering the profit also comes down. The risk of lowering the profit is reduced. These are countries which have had extreme success in the area of microfinance, starting with Bangladesh. We're all familiar with Muhammad Yunus and his Grameen Bank, which started in 1976. It's a huge success in Bangladesh, and a lot of countries have modeled on Grameen Bank to improve the economic status of the poor in their country. Some of these include Cambodia in the Far East, Colombia in South America, Ecuador, Nicaragua and Peru again in South America, Russia, and of course India. This is a famous case study of Grameen Bank and Muhammad Yunus, who believed that by doing good one does well in life. He started Grameen Bank at a time when Bangladesh was going through severe economic crisis. He gave up his job as a professor in one of the American universities. He returned to his country and saw that people were dying of abject poverty, and he believed that everybody, every soul, be it rich or poor, should have access to at least the basics, the basic needs of life. That thought fueled him to start off microcredit, and eventually he went on to start Grameen Bank. He was awarded the Nobel Prize for the success of Grameen Bank. Some of the microfinance institutions in India are SKS Microfinance, which is located in Andhra Pradesh, Hyderabad. There is Spandana Spurti Private Limited, Arman Financial Services, there is Bharatiya Samruddhi Financial Services, there is Grameen Kota and Village Financial Services Private Limited, Equitas Microfinance Private Limited, and so on and so forth. Now, what are the careers that one can think of in the area of microfinance? You can be a community investor. You can actually invest in the communities. You can become a microfinancer. You can set up a non-profit foundation. One example of non-profit foundation is ICICI Foundation, which is headed by Nachiket Moore. Then there are also careers in social entrepreneurship, like Seva, started by Ela Bhatt in Ahmedabad about 3 decades ago. With that, we come to the end of the basics of microfinance. I shall be happy to take you through the advanced course of microfinance at a later date. Thank you.